James Gerrish joins us from Shaw and Partners in Sydney. And James, before we get to what you're going to be watching through this session, what did you make of the overnight session?
Yeah, good morning to you, Ingrid and James. It was a bit of a soggy session, particularly in the commodity plays overnight. The oil market was weak, as you made mention of. So I think that's obviously going to flow through to what we see on our market today. SPI futures down 10 points, gives you some indication there. And BHP looking to open down around 40 odd cents. So look, some weakness, some profit taking in the resource space, which shouldn't really come as a massive surprise to investors. These guys, well, that sector has been on a pretty decent tear in recent times. So some short-term profit taking, I'd imagine.
Yeah, we've heard a lot of different analysts as well downgrading their expectations for commodities just on valuation, just on how far they've run up. But you're looking at a couple of things today, one of them being Crown, and we've got some new allegations coming through on poker machine manipulation. They are just allegations at this stage though, James, right?
They are simply allegations. It's being reported by the ABC News that a fourth whistleblower has come forward. So that obviously puts weight behind Andrew Wilkie's call around poker machine manipulation. He had 3 whistleblowers there back in October. Just to give some idea around the share price, back in October when all of this broke, the shares dropped to around $10.60 around the 18th, 19th of October. They've subsequently rallied up to about $12.53 as of yesterday's close. So another whistleblower out tonight suggesting poker machine tampering. Allegations, as you suggested at this stage, Ingrid, but it does give weight to it, and you probably see some selling in Crown today on the back of that.
But do you suspect, not like has happened in the past, do you see a little bit of bargain buying over the subsequent weeks and actually see the share price rally off the initial sell down on the allegations?
Yeah, potentially. I mean, this is gaining momentum. So you know, where there's smoke, there's probably fire in this regard. Just to go back to the share price moves, it did trade down to $10.60. We're now at $12.53. So there has been a really strong rally in share prices. Sort of these allegations have got out of the media. So this is going to bring it to the forefront of investors' minds again. So I doubt we'll see, you know, any bargain hunting for at least you know, some further downside, as in a couple of dollars downside, rather than a couple of cents downside that might play out today, James.
Okay, you're also watching Challenger Group. I know you've upgraded your price target, so you've got a buy on this stock.
Yeah, we do have a buy on it. It's been a really good performer of late. We've simply upgraded our price target, retained the buy. It's now 15.15 price target. So still plenty of upside. It's trading just shy of $14 now. So look, I own this stock across portfolios. It's simply around. It's hard to find growth in the market at the moment. Growth stocks are being more highly valued. So if your price, you know, Challenger on 20 times. And then uplift that PE to simply 24 times, which is pretty typical of a growth stock on the ASX at the moment, then you can justify a higher valuation. You know, that said, the stock has had a pretty good run, and I do understand that there was a time where, you know, the market put Challenger on a discount to market PE simply because they didn't understand the business, the metrics of how they underpinned all of their future liabilities. So, look, Challenger's done a good job in terms of market. Outlining their business to the market, communicating to the market, and the share price is really showing that. So we like the stock, good future growth, 15.15 target with a buy recommendation.
The annuity products very much underpinning the earnings growth for these guys, and then a lot of the blue sky thinking. How does that fare, and how does Challenger trade in an environment where interest rates are increasing? Yeah,
that's a really good point. So they made some changes to their business around getting rid of some of or reducing their sales of lower margin products. So the shorter annuity style products, which they got lower margin to, they've really focused their attention on higher margin annuities, the longer dated annuities, etc. So look, it depends what plays out in the market. So if we get a period where rising interest rates create market volatility, that's an environment where people sort of hide in annuities. So that could potentially be a really big boost for Challenger. So yeah, I think they'll do well in whatever environment. I think their balance sheet may has obviously been repaired, improved, etc. over the last few years, and they're in good shape going forward, no matter what the environment, I'd say, James.
And some recent good news for Challenger as well, in particular as it relates to Japan. That is seen as a huge market for them that they've moved into. But also, from what I understand as well, the fact that their products are being offered across platforms now, not just out of the Challenger actual vehicles, which again I imagine is good news. And does it also make it them, I suppose, less of a takeover target? Because that's been one of the other suggestions. Why don't one of the big four banks who are looking for, you know, earnings growth start looking at a Challenger? But Challenger might be a bit big for that now.
Yeah, I think they will be. I think you made two really good points there, just around the obviously distribution of their products, which is key. Going back to my point around margins, they made a decision to sacrifice sales to improve margins. But what we saw in their last update from the company is sales continued to be strong, even though they were also expanding their margins. The only issue with Challenger at the moment is that the bigger they grow, the more capital they need to raise. Obviously, you need to hold capital against a written annuity. It's a future liability. So, you know, they're constrained a little bit by their capital levels. It's not a constraint in the immediate term, but they will continue to raise capital over time, so through the various different avenues. In terms of the banks, I think we've seen banks should stick to what they do well, and that's that's around, you know, your everyday banking. I think the banks are shying away from going into these wealth management areas. You see ANZ has just offloaded their wealth management division. Wealth management is becoming a lower proportion of banks' earnings than it ever has been in the past. So I really don't think that's an avenue for the banks to go down.
Well, speaking of that, ANZ, IOOF sort of seeing it as the next bright light for them, and certainly they've seen an upgrade from Morgan Stanley as well, $13 price target there. Does that have to do with their new strategy?
Yeah, IFL obviously just bought ANZ's wealth management business, so they're up scaling their business pretty dramatically on the back of that. It's going to be earnings dilutive in year one, but earnings are accretive in the outer years. And I guess the market's pricing that earnings accretion in those outer years. So look, I own IFL in our portfolios. It's been we've bought it into the recent drop, which where they raised capital to fund the purchase of ANZ's business. I think it's got, you know, strong future growth. The wealth management space, or the platform space, the independent platform space, is really gaining momentum. We've seen, you know, Net Wealth come onto the market at a really strong multiple, etc. You've got Hub24, but IFL is the dominant player in the sector. AMP is also the dominant player in the sector, but I think IFL, in terms of technology, in terms of the product offering, and overall products they have on their platform are a far superior product. So IFL, for mine, is a good bet around these levels.
So you have a preference for your clients for IFL over some of these platforms, in particular Hub and Net Wealth?
Well, to give you an idea, so the platform space is dominated by the big four banks, AMP and IFL, and they account for about 78% market share. So these new players coming in, the four listed players on the ASX, account for about 4% market share. So they're going to grow, there's no doubt about it, but they don't have the scale just yet. They're trading on really lofty multiples, 50-odd times earnings. They're great products. You know, Hub is, on last look, it's capped around, you know, $500 million, which is still reasonable at this stage. A lot of the other ones are capped at lower levels. So, look, there's going to be growth in that area. I think the whole sector is something to be conscious of and be watching out for. We've got IFL in the portfolio now, a larger cap, more liquid play, but I think it's well and truly worth looking down the food chain as well, guys.
Looking at Net Wealth, though, you know, when you see something come online like that and just have such a stellar day and I mean, it's been a couple of weeks now and it's still sort of continuing those gains. Do you see that as a time to sort of hold back and perhaps not get into the stock? Would you wait it out a little bit?
Yeah, if you're lucky enough to get through the IPO, and stock was pretty scarce through that IPO, then obviously you're probably going to be topping up on market because your average price is still going to be reasonable. If you're going to add new money to into the stock, then I'd probably be waiting for some type of weakness. But I guess the demand in this area of the market shows how the consumer of financial services products, where they want to go, the avenues they want to take. They want independence. They want, you know, an impartial platform provider. They want, you know, direct exposure in equities, etc., rather than going through managed funds and the like. So I think it's a really strong growth area. I think there's a lot of scope for this area to grow, and you're seeing that in the multiples being paid for these stocks. But you know, if you do get some weakness in these net wealths, etc., Hub 24s of the world, then use it as a buying opportunity, because I think it is a really strong growth area.
James, looking quickly, just the older world style of it, the banks, as you say, the big four still dominating in terms of the platform offering. Just a thought on what seems to be almost, well, an ever-increasing likelihood of some sort of an inquiry into the big four banks. Seems to be a commission of inquiry as opposed to a royal commission, though there's not much difference between them, to be fair. I mean, does it continue to hang over the heads of the banks, do you think, as far as the market is concerned? Is the market worried? How do you think investors, traders view the likelihood of something like this as far as the banks are concerned?
Yeah, I think from a market's point of view, markets don't like events that come from left field or shocks that we haven't been across, or things that you know, we haven't predicted. And I think an inquiry has been on the table for such a long time. The market has really digested the likelihood of that. I know, you know, the market probably thought that it wasn't going to happen, or a royal commission wasn't going to happen. But you know, if it does, I don't think it's going to be a major impost in terms of earnings and whether or not banks get bid up in terms of share price. I think there's a few bigger external factors that influence bank share prices, their earnings, etc., than a potential royal commission or a bank inquiry would, James.
But it's destruction of management, isn't it? Destruction of management that's the issue for share prices.
Yeah, totally. There's no doubt about that. I mean, it saps resources, it costs money, and it is just a continual hype in the media and negative publicity that they've got to manage. But you know, banks have dealt with that for a long period of time. It's not new to them. It's pretty sad to say that it's not new to them. Really, at the end of the day, there is a huge amount of improvement that banks need to make in the way they operate with customers, etc. And I think it speaks to this huge demand for independent wealth management platforms, and that's why these new entrants with better tech, non-aligned products, etc., are doing so well. They're attracting so much FUM onto their platform simply because of the way banks have behaved in the past. And you know, the bank earnings relative to what's happening on platforms is so small now. So you know, it's not a massive part of bank earnings by any stretch.
All right, James Gerrish, appreciate your time on the program as always. Thank you.
Thanks, guys.